Okay, welcome back, everybody. Today we're going to be covering Chapter 4. It's pertaining to intercompany transactions, in particular merchandise, plant assets, and notes. First off, let me just say that I'm sorry for not being in class this evening. I just feel like this chapter, it's just a quick little chapter. It's not going to be that long of a, not that long of a lecture. I'm stopping this. I don't like it. Okay, welcome back, everybody. Today we're going to be covering Chapter 4. It's dealing with intercompany transactions, in particular merchandise, plant assets, and notes. Okay, so our learning objectives for this chapter: explain why transactions between members of a consolidated firm should not be reflected in the consolidated financial statements. Defer intercompany profits on merchandise sales when appropriate and eliminate the double counting of sales between affiliates. Defer profits on intercompany sales of long-term assets and realize the profits over the period of use and or the time of sale to a firm outside the consolidated group. Eliminate intercompany loans and notes, and discuss the complications intercompany profits create for the use of the sophisticated equity method. Okay, and on the appendix learning objective number 6, we're not going to touch on that one here, so just topics 1 through 5 here. Okay, so what are some of the typical intercompany transactions that we could expect to see between a parent company and its subsidiary? Okay, it lists 4 here. These are your most typical type of intercompany transactions that we would expect to see. First being merchandise for resale. Next being land. The next being fixed assets such as like vehicles, equipment, buildings, stuff of that sort, and notes receivables and payables. Okay, intercompany merchandise sales. So this is a sales between an affiliated companies are going to be recorded in the normal manner on the books of the separate companies. So what this means, if the parent company makes a sale to a subsidiary company, or if a subsidiary company makes a sale to a parent company, then they're going to record the sale and the receipt, or the whatever the cost of the sale is, to whoever's on the receiving end, in the same manner as if they would sell to an outside party, or if they would be purchasing from an outside party. Okay, for the consolidated financial statements, they do not involve parties outside of the consolidated group, right? So this is only going to be parties inside of the group here. These cannot be acknowledged in consolidated financial statements. So once again, for the consolidated financial statements, I feel like I messed that up a little bit. These do not involve parties outside the consolidated group, all right? Cannot be acknowledged in consolidated statements. So what this means right here, if the sale is between the parent or the subsidiary, then it cannot be acknowledged in the consolidated statements. Only a purchase or a sale to a company outside of the affiliated companies can be actually counted within the consolidated statement. So that's what that means. Do not involve parties outside the consolidated group, then it cannot be acknowledged in the statement. So meaning if it's between the parties there. Procedures for consolidating affiliated companies with intercompany merchandise sales. First, we want to eliminate the intercompany sale. Next, eliminate related intercompany debt and receivable. And then profit is going to be realized when the goods are actually sold to an outside party, okay? So let's look at an example of an intercompany sale, okay? So we can see at the top here on this little timeline here, we have company P, we have company S, and then outside, okay? So obviously company P and company S are going to be affiliated companies, right? And this is the outside customers or companies, whoever the outsiders may be. So right here, company P, they have a cost of their goods. So what they purchase their goods for is $1,000 from an outside person, right? And then they're going to sell to S, which is an affiliated company, for $1,200, right? And then company S takes and sells to an outside company for $1,500. Okay, let's look at the combined income statement, and this is going to be without elimination. So we're going to account for all the data here without eliminating any of the intercompany transactions. So the sales in that case would be the $1,200 from company P to company S for when they sell to S for $1,200. plus the $1,500 where company S sold for $1,500 to an outside party. So we know that makes up $2,700 for a total sales of $2,700. And the cost of goods sold would be the $1,000 from company P where they purchased from an outsider, plus the $1,200 cost of goods sold that company S has incurred when they sell to the outsider. Because remember, company S, their cost of goods is what they receive the goods from company S for. In this case, it's $1,200. So we know 1,000 plus 1,200 is 2,200. We know gross profit is sales less cost of goods sold. So in this case, it'll be $500. And the gross profit percentage in this case will be 18.5%. Okay. Now let's look at a consolidated income statement over here on the right. And in this case, the intercompany transaction has actually been eliminated. Okay. So in this case, sales are only going to be the $1,500, which is the sales to the outside party. Because if you recall from the previous slide, it cannot be included in the consolidated financial statements unless it involves an outside party, right? So in this case, the $1,500 is going to be the only sales that is relevant because it's made to the outside party right here. The cost of goods sold is going to be the $1,000 that the parent company, we'll just say P, company P is the parent in this case. That's what the cost of goods were when they purchased the inventory from an outside party. So only the cost of goods from the outside party and the sales to the outside is what's relevant in the intercompany consolidated income statement. Okay, so we have sales of $1,500 to the outside, cost of goods sold from $1,000 from the outside, which gives us the same gross profit. Notice the gross profit's the same at $500. And the gross profit percentage in this case is going to be 33.3%. Okay. So once again, the intercompany sale of $1,200 is going to be eliminated on the worksheet, right? Meaning the $1,200 right here. Okay, what about intercompany price? Does the intercompany price really matter if we're going to be eliminating it? The intercompany price will be relevant if there is a non-controlling interest. So it says here, yes, the intercompany price matters if there is a non-controlling interest. We know the non-controlling interest is when a parent only owns a certain percentage of the company, or say for example they own 80% of the common stock, so the other 20% would be considered the non-controlling interest. We've established that in previous chapters. The reported net income of the subsidiary reflects the intercompany sales price. So once again, reported net income of the subsidiary reflects the intercompany sales price. So what that means is obviously the intercompany, whatever the intercompany's price was for, in this case right here, the $1,200, that is going to enter into whatever their net income is going to be, because that'll be their cost of goods sold for the subsidiary. The subsidiary's separate income statement becomes the base from which the non-controlling share of income is calculated. Okay. So once again, the subsidiary's separate income statement becomes the base from which the non-controlling share of income is calculated. So that's why the intercompany price does matter if there's a non-controlling interest, because that's going to enter into the determination of net income that is allocated to the non-controlling interest. Okay. So once again, if company S is an 80% owned subsidiary, then the non-controlling interest will receive 20% of the $300, which is the $1,500 minus the $1,200 profit made in the final sale by company S, or $60. So once again, they're saying that they're going to receive 20% of the $300. That right here is going to be between the $300 between, this is company S's cost of goods sold right here, because that's what they purchased it from company P. Okay, and when they sold to outside the $1,500, so there's their gross profit right here, $300. What they're saying is the subsidiary is going to receive 20% of that $300, because once again, remember, the subsidiary's separate income statement is the base from which the non-controlling share of income is calculated. So that's where that $60 comes from right there. So the intercompany price is relevant if there is a non-controlling interest. So let's talk about like markup confusion here, okay? A lot of people think that a markup on cost is going to equal the same as the gross profit, but that's actually not true. So we can see here from the slide that the markup on cost does not equal the gross profit. So let's look at a simple example here. So let's say we have something that costs us $10, right? And we want to mark that unit up 25%. So in order to do that, we would take the $10 cost, right here, multiply it by 25%, or mark it up 25%, which would be 10 times 1.25 equals 1250. So there's the 25% markup on cost, okay? But the 10% or the 25% markup on the $10 cost is only going to provide a gross profit of 20%, as we can see here, because the 25% markup on cost of $10 is $250. That's the 25% markup on cost. Okay, well, the $250 divided by the total price of $1250 is only 20%. Okay, so once again, this is just a quick little clearing up of the fact that markup on cost is not equal to gross profit. Okay, so let's look at a merchandise example. So S, which P owns 80% of, buys goods for $80,000 and then sells them to P for $100,000. All sales are at a 20% gross profit, okay? P's inventory of intercompany goods, the beginning balance is $10,000, the ending balance of inventory is $15,000. Now P is going to owe S $8,000 for intercompany goods at year end, okay? So some consolidation procedures that are going to be needed for this type of a transaction. Once again, we're just adding to these elimination entries that we've seen in previous chapters here. So just bear with me. The IS is going to eliminate the sale from subsidiary to the parent. The BI is going to reduce the cost of goods sold for profit in beginning inventory and correct beginning retained earnings. The EI is going to reduce ending inventory and increase cost of goods sold. And this is because ending inventory values contains intercompany profit. And then IA is eliminate intercompany trade balance. Okay, so let's take a look at some of these examples here. So here's some worksheet eliminations, okay? So we have the partial worksheet. So we have the trial balances of company P and company S, remember? So let's get a refreshing here on what these numbers actually are. Okay, so remember, S is the subsidiary in which P owns 80%, right? So S buys goods for $80,000 and sells them to P for $100,000. All sales are at a 20% gross profit, okay? So let's see. I'm sorry. So let's take this beginning inventory 10,000, ending 15, POS 8,000. Okay, so let's jump back here to our worksheet elimination. So we can see here company P. Remember, the ending inventory is 15,000. Remember, company S is owed $8,000 from company P because it says company P still owes an accounts payable of $8,000 to company S for the purchase that they had intercompany. We can see here the retained earnings of company S and company P. Sales $130,000 for company P, $100,000 for company S. The cost of goods sold $95,000 for company P and $80,000 for company S. Okay. So let's look here. Hold on, I'm sorry, wrong way. Okay, so first thing, IS. Let's look at that entry. Eliminate sale from subsidiary to parent. So where is the IS? Let's see. Here it is, right here. So sales. Okay. Remember, company S, which P owns 80%, buys goods for $80,000 and sells them to P for $100,000. So obviously the $100,000 in sales was an intercompany sale. So for IS, remember, we want to eliminate those sales. So how we do that? We debit the sales, okay, for $100,000 because we know sales is originally a credit. So we have to debit it to eliminate it for $100,000. And then we want to credit the cost of goods sold as well for IS of $100,000. So that eliminates the sales, right? Because we know sales is originally a credit amount. Cost of goods sold is originally a debit. So that's why we're seeing the opposite effect here. So that is the eliminating entry, IS, eliminate sale from subsidiary parent. Once again, I'll let you look at it again. We have the sales here. We're eliminating the sales for company S here. That's going to be $100,000 and then $100,000 here. Next, the BI, reduce cost of goods sold for profit in beginning inventory and correct beginning retained earnings. Okay, this is going to be allocated 20 to 80 because sale was by a subsidiary. Okay, so in this case, it's going to be can be allocated because, once again, the sale was by a subsidiary. If it was by the parent, it would not be. So it's allocated 2080 once again because the sale was by a subsidiary. So let's go look at the BI entry on the worksheet. Okay, so where is the BI? Here we go. The BI right here is it's relating to retained earnings and to the cost of goods sold, remember? So we have to reduce the profit out of beginning inventory, right? So retained earnings for company S, 20% of that is $400. Retained earnings for company P, 80% of that is $1,600. Okay, and then the cost of goods sold being reduced would be $2,000 right here. Okay, the EI entry, reduce ending inventory and increase cost of goods sold. So ending inventory value contains intercompany profit. So let's look at the EI. Okay, so cost of goods sold, we want to debit that for $3,000. Okay, and then also credit ending inventory by $3,000, right? And once again, that reduces ending inventory and increases cost of goods sold because remember, ending inventory value contains intercompany profit. So all we're doing right there is reducing the ending inventory by $3,000 and also increasing cost of goods sold by $3,000 because once again, we need to reduce the intercompany profit. That's how you accomplish that, because if you increase cost of goods sold, obviously it's reducing profit. Okay, the last one, IA, eliminate intercompany trade balance. So let's look here. The trade balance, remember we said that company S is still owed $8,000 from company P, which owes $8,000 to company S. So once again, company P, accounts payable to company S for $8,000, accounts receivable from company P of $8,000 here. So how do we do that? The accounts receivable, we know accounts receivable is an asset, original debit, so we credit it here. And then the accounts payable for company P, we know accounts payable is a liability, original credit balance, so we debit it here to eliminate it. So once again, these are going to be our consolidation procedures needed for the intercompany sale. Okay, so I know it's a lot coming at you. Just work through these as we move through it. There's a lot of really good worksheets in the back of the chapters of these consolidation chapters that really breaks it down into detail. Very, very good. But you'll get some practice on this on the quiz and the homework as well. So once again, there's your worksheet eliminations relating to these consolidation procedures right here. Okay, so let's make our adjustments to the income distribution schedule. So once again, this is the IDS is the income distribution schedule. Okay, so let's start with the subsidiary. Okay, in this case, they had internally generated income of $20,000, right? Remember, they had a beginning inventory profit of $2,000 from the BI entry up here. 2,000. Remember, we reduced the cost of goods sold, so there's the 2,000 right there. Okay, and then the ending inventory profit of 3,000. Remember, we had that reduced as well. The ending inventory profit here, so cost of goods sold, ending inventory profit. So that's what we're seeing right here. Okay, so obviously the income 20,000 plus the beginning inventory profit recognized of 22,000, back out the 3,000 that we increased on the cost of goods sold, is going to give adjusted income for the subsidiary of $19,000. Okay, now the non-controlling interest, remember, that's based upon the subsidiary's income statement, so that's why we're seeing the non-controlling interest share of income right here, because remember, in this case the non-controlling interest is 20%. And that's 20% of the adjusted income of the subsidiary based upon the entries we just made on this page here. So these entries once again carry down onto the IDS, which is the income distribution schedule. You start with the subsidiary. Once again, internally generated incomes 20,000, beginning inventory profit of 2,000 added in, and then the ending inventory profit of 3,000 backed out. Once again, that leaves us adjusted income of 19,000. And that's where the non-controlling interest share of 20% is calculated off of. And then next, let's look at the parent. They have internally generated income of 35,000. And then remember, the parent in this case owns 80% of the sub. So in this case, 80% of the sub's adjusted income. So when we go, the parent's percentage of income is based upon the adjusted income of the subsidiary after the eliminations have been made. Okay. So in this case, 80% of 19,000 is 15,200, and obviously 35,000 plus the 15,200 is going to be the controlling interest income distribution schedule, or 50,200. Okay, worksheet 4.3. The four eliminations, once again, are IS, IA, BI, and EI. So once again, we are just expanding on these IS, BI, EI, IA, these entries here. So once again, the four eliminations are IS, IA, BI, and EI. An elimination BI, adjustment to retained earnings, is split because partially owned sub was the seller. So remember in this entry here, it was from the seller, the BI. Remember, it was split between the retained earnings here, 80-20. So what they're saying here, if parent or wholly owned sub is the seller, then adjust only to parent's retained earnings. So once again, if the parent or wholly owned sub is the seller, adjust only to retained earnings of the parent. The adjustment to retained earnings is going to be split once again if it's a partially owned sub making the sale. So that's the only time it's going to be split, okay, is if it's a partially owned sub making the sale, or if it's the wholly owned sub or the parent, only adjust to retained earnings of the parent. Seller's profit is added, or I'm sorry, is going to be adjusted through the income distribution schedule. In this case, the adjustment went to the sub, the seller. They would go to the parent if the parent was a seller. So you're going to adjust whoever is the seller. In this case, it was the sub. Okay, if there is a lower cost of market adjustment, remember this is what inventory has to be carried at, as lower of cost of market, and as per GAAP. So if there is a lower cost of market adjustment, only the remaining profit is going to be eliminated. Okay. So whatever the difference would be after a lower of cost of market adjustment, the remaining profit is going to be eliminated. Losses, i.e. sales below market value, are also going to be eliminated. So we have to eliminate intercompany losses as well. And once again, worksheet 4.4 shows the same adjustments for a periodic inventory. Okay, now let's talk about an intercompany sale with a non-depreciable asset, okay? So for a non-depreciable asset, that's going to be an example as land, right? So let's see here. Land's what they're using here. So the gain is going to be deferred until the asset, in this case, land, is sold to the outside party. Remember, we're only concerned with transactions with the outside parties, not intercompany transactions. So for an intercompany sale of a non-depreciable asset, we want to defer the gain, okay? So we can see here the journal entry in the year of the sale. So to defer the gain, we're going to debit a gain on sale, right? So we're going to just kind of hold that gain in that debit, because usually a gain is a credit, right? So in this case, we want to debit gain on sale and credit land for $20,000, okay? And this is going to run the adjustment through the seller's income distribution schedule. Once again, the income distribution schedule is this thing right here. Okay. Okay, so back to this. Remember, we're deferring the gain. So debit gain on sale, $20,000, credit land, $20,000. This removes the land from the books. This defers the gain, okay? Later years, okay. Retained earnings split. Adjustment is split if the seller was partially owned sub. Remember, if it's the wholly owned sub or the parent selling, then it's not going to be split. But in this case, retained earnings split. If the seller was partially owned sub, in this case it was. So retained earnings split. Just throw that out there. $20,000. Land, $20,000. Okay. Year of sale to the outside party. Retained earnings split once again for $20,000, and then credit the gain on sale. So finally, we can recognize the gain. So credit to the seller's income distribution schedule of $20,000. Okay, because once again, this is to an outside party. Now let's talk about an intercompany depreciable asset sale. So this is going to be the year of the sale. Okay, so we're going to assume that we sell a 5-year machine with a net book value, okay, of $20,000. And we're going to sell it for $30,000 on January 1st, 2015. Okay, so the theory on an intercompany depreciable asset sale is going to be to defer the gain and then earn it back over a period of use, okay? Now, the allocation method matches the depreciation method, straight line for this example, okay? So what we mean by defer gain and earn it back over a period of use is we're going to recognize the gain the same way we would recognize depreciation on an asset, okay? So let's just look at an example here. So let's say the year of the seller, okay? Remember, we have a net book value of $20,000, and this is the depreciable asset that we sold for $30,000 on January 1 of 2015. So on the year of the sale, we want to defer the gain. So once again, we debit the gain, and this is the seller of $10,000, credit the machine for $10,000. So once again, it tells you over here to the right what these journal entries are accomplishing. So gain from the seller, $10,000, that defers gain on sale. Credit machine for $10,000. This returns asset to cost, okay? Because remember, right now we're just deferring the gain. We know the gain is the difference between the proceeds less the net book value, $10,000 in this case. So deferred the gain of $10,000. Credit machine, $10,000. That returns assets to its cost of $20,000. Okay. F2, debit accumulated depreciation for $2,000 and credit depreciation expense for $2,000. Okay, the debit to accumulated depreciation of $2,000 reduces to depreciation on cost, and the crediting of depreciation expense obviously reduces an expense. So that's going to mean we recognize 1/5 of the profit because we know $2,000 is 1/5 of $10,000. Okay, on the income distribution schedule, deduct original profit from seller and add profit equal to depreciation adjustment. In this case, is this. Okay, what about the end of the second year? So we want to adjust asset at start of the year. So retained earnings split. Remember, retained earning adjustment is split when partially owned sub is the seller. In this case, it was. But remember, if it was a wholly owned sub, or if it was the parent, then we would only adjust the parent's retained earnings adjustment, right? But right here, remember, it's split because it's a partially owned sub. It's going to be the seller. So we debit the retained earnings for $8,000, and this is the deferred gain on 1/1/16. Because remember, let's look back here. Remember, we made the sale on 1/1/15. At the time of sale, we sold it for a $10,000 gain. The proceeds of $30,000 over the net book value of $20,000. So at 1/1/15, the deferred gain was $10,000. Okay. Well, we recognized 1/5 of the profit right here. So at the beginning of the adjusted asset at the start of the year now, we only debit retained earnings for $8,000, which is the deferred gain, because we already recognized $2,000 here. Okay. So on 1/1/16, there's only $8,000 left of the gain to defer. Okay. Then accumulated depreciation of $2,000, which is adjust the prior year's depreciation, and then credit the machine back $10,000, which returns asset to cost. Okay. Okay, adjust current year depreciation, debit accumulated depreciation for $2,000. This will reduce to depreciation on cost. Credit depreciation expense of $2,000. This is recognizing another 1/5 of the profit. Once again, the income distribution schedule, seller gets profit equal to depreciation adjustment. In this case, $2,000 it's seen right here. Okay, fixed assets worksheets. WS 4.5 year of sale. So worksheet 4.5 year of sale. F1 eliminates the $10,000 gain, which reduces machine to book value. Okay, and once again, these are just the entries we've went through right here. F1, so it's saying here, F1 eliminates 10,000 gain, reduce machine to book value. So we can see here, that's what that does, reduces the gain and returns asset to cost. Okay. F2 adjusts current depreciation and realizes 2,000 gain. Once again, we can see that. F2 adjusts the depreciation, reduce the expense, which recognizes 1/5 the profit. Income distribution schedule of seller, defer the 10,000 gain, realize $2,000. Okay, so once again, we knew we deferred the 10,000 gain, we realized 2,000 of it. Okay, worksheet 4.6, end of second period after sale. F1 removes profit from machine value and eliminates gain unrealized as the beginning of the year from retained earning of seller and adjusts accumulated depreciation for profit realized years. Okay, so once again, the F1, that's this entry right here. Okay. F2 adjusts current depreciation and realizes 2,000 gain. Same thing. Just accumulated depreciation, reduces depreciation expense, recognize 1/5 of the profit. So once again, that's what it's talking about for the F2. And then the income distribution schedule of the seller is realizing another 2,000 of the gain. Okay, so once again, we're realizing another 2,000 of the gain right here. Okay. Okay, fixed asset worksheets. The continued slide here. So worksheet 4.7, assets sold to outside party at the end of the second year. So machinery and accumulated depreciation are not there to adjust. Okay, So we're not worried about the machinery and accumulated depreciation on the year of disposal. The 6,000 remaining gain at the start of the year is now earned because of the sale to the outside occurred, right? Because recall in these earlier slides, remember the beginning of the year, remember we recognized 2,000, 1/5 of the profit at the end of the first year. The second one, we recognized another 2,000. So out of the 10 that we've deferred, that we've recognized 4. So that's where they're getting the 6,000 deferred gain. So we still have 6,000 deferred gain, right, when we sold it. But the 6,000 remaining gain at the start of the year is now earned, right, because we sold it to the outside. So now they're combining the 6,000 deferred gain. Remember the 10,000 original less the 4,000 recognized, 2,000 in 2015 and 2,000 in 2016, and the recorded 4,000 loss on sale to an outside party creates a gain on the consolidated income statement of $2,000. So in this case, they're saying that we recorded a 4,000 loss on the sale to an outside party, right? But overall, the net of the transaction between the intercompany and the outside sale is going to result in a gain of 2,000 for the consolidated statements. Okay. What about intercompany debt? Typically, the parent is going to lend to the sub. It can be the opposite way, but typically it's going to be downstream. It's going to be from the parent lending to the sub. Okay, eliminations is LN1 intercompany payables and receivables, in LN2 interest expense and revenue. And this is familiar. This is similar to what we saw up here in the schedule up here when we eliminated the accounts payable and accounts receivable right there. So that's what we're talking about down here on intercompany payables and receivables and interest expense and revenue. Okay. Now in terms of the income distribution schedule here, the sub's internally generated net income is not going to be adjusted for incurred intercompany interest expense. Okay, so once again, the sub's internally generated net income is not going to be adjusted for incurred intercompany interest expense. Okay, sophisticated equity method, intercompany transactions. Sophisticated equity method records subsidiary income net of all intercompany profits. Okay, so once again, net of all intercompany profits. So we're eliminating all these is what that's saying right here. The parent prepares an income distribution schedule for the subsidiary to determine and record its share of subsidiary income. So once again, the income distribution schedule is this thing here that we're talking about. So unrealized profits of prior periods, the parent's beginning retained earnings does not include it. Okay, so the parent's beginning retained earnings does not include unrealized profits of prior periods. The sub's beginning retained earnings does include profits of prior periods. The adjustment replaces beginning inventory to remove intercompany profits from sub's beginning retained earnings into parent's beginning inventory. Okay, so once again, that was something that we also saw up here in this entry up here with the inventory right here, how we eliminated the EI and down to here. And this, but the only difference is now it's being replaced for the sub's beginning retained earning and the parent's beginning inventory. Okay. So this is all for chapter 4. Once again, it's intercompany transactions, dealing with intercompany transactions with merchandise, plan assets, and notes. Pretty much the main thing of this chapter. It's not a whole lot added. You've kind of got the routine here now with these first 4 chapters. It's all just adding a step on each chapter here. So the main thing out of this chapter really is just to know that the only thing that really is that matters is this stuff with outside parties. We're purchasing from outside parties and selling to outside parties. Anything intercompany has to be eliminated. Okay, so that's really the main issue there. Remember, some things intercompany does matter in terms of if there's a non-controlling interest. Recall that the non-controlling the intercompany price does matter for the non-controlling interest, because that's how their share of income is going to be determined from their percentage of ownership in the subsidiary. So once again, that is all for chapter 4. I will be posting chapter 4 quiz and homework, so be on the lookout for that. I wanted to point out some things right here real quick in the class. Let's see here. So advanced accounting, that's what we're in here. Oh, okay, so this is the week we're in right here, the 3rd through the 9th. And I know the weeks look weird because of the way they compressed this semester, so I apologize again about that. So once again, Chapter 3 quiz, I got that up today. Let's see, let's look here. You have till the 15th, so I apologize for that being late getting up, but you have till the 15th on Chapter 3 quiz, so you have a week on that. Chapter 3 homework, that was last week. I'll go ahead and I'll get the solutions available so you have those solutions and you can check your work before you submit it, because I believe it is due tonight. So yes, it's going to be due in 9 hours from now. So I will go ahead and make sure I post Chapter 3 homework solutions here. I'll make them visible. This is the teacher view, so I'll make this visible for the students to see. So check your homework. Make sure you submit that tonight. Chapter 4 lecture, I'll be posting that right under the PowerPoint. So here's Chapter 4 PowerPoints. Once again, Chapter 3 quiz. You have a week on that. I'll be posting Chapter 4 homework. And Chapter 4 quiz is actually already available. And you have until the 22nd to work on that. So you notice here, I want to point out next week we have, well, this is next week right here, the 10th to the 16th. So my plan is to work over some problems in class here the next couple weeks and do an extensive exam review on this day of class here, and then probably go over some questions from quizzes 1 through 4 in this class period here. So I purposely scheduled it this way because in my opinion, this is one of the most heavily tested things on the CPA is on FAR. They like to talk about consolidations. Not one of the most heavily, but there's a lot on it. And I just feel like the consolidations is one of the hardest. It's one of the most difficult parts of the class. So I just want to point those things out. Once again, that's the end of Chapter 4. If anyone has any questions or concerns, please let me know. I'll be more than happy to help anyone out. I hope everyone has a good day, and thank you for your time.